Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, February 19th, and this is the weekly market update. The disclaimer, as always, anything that you see or hear on this video or podcast is not to be taken as investment advice. This is for general knowledge consumption. I am not a financial advisor. I am not authorized by your statist government overlords to give you personal financial advice. So you need to do your own due diligence. You need to take your own responsibility. It's your money. It's your issue. So let me move this over here. I wanted to talk about one of the indicators that I use to determine when things are getting out of whack, and I might want to start selling down some of my positions. So what this is on the St. Louis Fred site. They have all the data. You can go on and get data. You can go look this up yourself. This is, look in the upper left of this chart. It tells you what I'm looking at. Basically, this is the spread between the high yield index, which are junk bonds, and the 10-year treasury rate. And what you can notice is you can take this back if you go on the St. Louis Fred site and look at the previous recessions. And one thing you'll see, this is the pandemic recession, if you will. You see what happened was, as liquidity tightened, as conditions got bad, as we had the dislocations in markets, the spread between junk bond yields and treasury yields blew out. Why? Because people become fearful, liquidity shrivels up, junk bonds are very risky, or quite a bit riskier than treasuries, and so people begin selling them. And if you recall, the interest rates on bonds are inverse to the price of the bond. So when people start selling, liquidity dries up, general interest rates are going up, you have a tendency to see these things blow out. People go into treasuries, which causes the price of those to go down, and rates, or the prices to go up and the rates to go down for a safe haven, and they sell off junk bonds, which are riskier, and they blow out. And so what we're seeing here recently with all of the Fed tightening talk and all this, we're starting to see this climb again. This is updated daily, so can't really show you this because this is a captured picture, but we're at like 3.74%. So we're not in danger territory, because you can see this thing varies throughout, between, basically around slightly under 4% is pretty much the norm, and occasionally blow out, right? This is when back in 2018, late 2018, early 2019, when Mr. Powell had his little hiccup last time he was going to try to raise rates. And you saw what happened there. But you see that we're starting to climb a little bit here. It's getting a little bit more volatile. This is something I watch. This is starting to go in the direction we don't want it to go into. And so, we haven't even really seen real tightening by the Fed. We haven't seen any real interest rates. Yes, they've peeled back a little bit of QT, but they're still buying bonds in the market. And so we have a lot of volatility in a lot of these markets, because there's a lot of uncertainty. There's a lot of speculation of what the Fed will do, what they won't do, how many times they're going to raise rates. I'm not a macroeconomist. I'm not going to try to speculate what the Fed's going to do. I'm not going to try to predict what the Fed's going to do. What I'm telling you is that this is one of the tools I use to let me know when the markets are starting to dislocate and when I probably need to start paring down positions. We're not at that point yet, but this is a tool I use, and we are starting to move in the wrong direction. If this thing gets above 4% and keeps moving higher, I'm going to be looking to pare back positions, because the market is beginning to get dislocated. But I'll be looking for, are rates actually being raised, and how much liquidity is actually in the market. Now, there's other tools I use too. This is the only one. I use another tool that compares gold to the general commodities, and that's currently starting to weaken a little bit, where gold is outperforming like the CRB. That has generally been another good indicator for upcoming recessions. And so I just wanted to bring this to your attention, that it's not a straight linear shot. We're going to have volatility. I can't predict the future directly, but what I have tried to do is find some indicators that I've been able to find from other folks that I've back tested and looked at that have been pretty good indicators of when liquidity is starting to dry up and when we're going to see more volatility. Stanley Druckenmiller said there's two things that basically move markets, and he said one of them was sentiment, the sentiment towards the market, the morale of the market, if you will, and liquidity. It didn't say anything about earnings or forecasted earnings. It was sentiment and liquidity. Marty Zweig, a guy that I follow, he's dead now, but he was a guy that was pretty active in the 80s and early 90s. He talked a lot about don't fight the Fed and 3 steps in a drop. That means 3 rate increases by the Fed, then the market would drop. Same thing, when they cut 3 times, the market would go up. And so these things are general rules. Now, they're not all set in stone. I don't mechanically follow these things, but, we're not in the pandemic situation here. But typically what happens with the Fed, and you can even see it back here when Mr. Powell had his hiccup in late 2018 when he was going to try to raise rates then, and the market dislocated on him. You saw that the spreads blew out to over 5%, and he immediately reversed course, and then everything settled down again until we had the pandemic-induced dislocations in the world economy. Now, what's interesting is on the liquidity front, it's not just the U.S. You have to look at the entire world. The entire world overall is tightening, okay, liquidity. That's not good. That's not positive. So we have to keep an eye on this. And like I said, that's why I keep talking about volatility. So I just wanted to introduce you. Another thing I look at is, junk bonds specifically. This is JNK. It's the Barclays high yield bond ETF. Junk bonds, basically, that's why they have the symbol JNK. And you can see how it's dropped recently, right? Just this year, if you will, which coincides basically with spreads starting to blow out. So people, even though we haven't seen any massive interest rate increases or really super amount of tightening, people are front running this. So I didn't push this out to, you can go on stock charts and play with this chart and get a longer view, a more historic view. But is this really a chart that you would want to buy? I mean, you can kind of see almost a triple top here that developed, right? Then it blew out below that. So if you want to even call it a double top, triple top, I don't know. Like I said, I'm not going to read chicken entrails on here, but this is not a bullish chart, you will. Now this thing dropped and looks like it might be recovering a little bit. So, we don't know, but this is not positive for junk bonds and for an indicator of liquidity in the overall market. The other thing I wanted to talk about, which I thought was interesting, in the February issue of the Actionable Intelligence Alert, we got bullish on gold again. And I kind of talked about some of the reasons why. We have some gold stocks in the portfolio. And I also, I think, talked maybe 2 weeks ago or a week ago about Caledonia, one of my favorite companies I talk about publicly. And the same thing here, did we break out? I don't know if we have a breakout from this basically year-long, 18-month-long since the all-time high of 2089. But this is what happens, right? Gold was up, did well in 2019, 2020, and then consolidated through 2021, right? And it looks like we may be breaking higher. And so it was interesting when I was on with Trader Ferg earlier this week. He interviewed me. It's on Crux Investor. I think it's behind the paywall. But he asked me about gold. Now, he's not a big gold fan. He doesn't, speculate or invest in gold. But he asked me, and I said, yeah, I'm getting more bullish on gold just because sentiment is so horrible towards gold. And it kind of fits into the framework that I'm looking at of why I'm getting bullish on gold. So you have sentiment blown out. You just had like Barrick today, I think today or yesterday reported earnings. They have a huge buyback going on. The gold companies, the gold stocks are not like, making the mistakes of the past where they would go out and just drill away all their cash flow or make some stupid acquisition and blow their wad and go into debt. And so what we're seeing here is sentiment's really low in the gold market. I kind of talked about real rates being, historically negative, and we didn't see a big reaction in gold. But then the thing I pointed out was, we had 2 years of pretty good gold gains in gold. We had an all-time high. And then, this is what typically gold sometimes does, right? Then it will just like go sideways or consolidate this huge move from basically 1100 to 2000. And then, nothing goes in a straight line. And if you roll this chart out for several years, what you will see is this very well-defined cup and handle formation, where if you extrapolate this chart out to the left, it creates like this cup. This would be the handle. And then typically what you see in these type of longer term, now this is over several years, it will happen. It wouldn't happen in just the next week or two, but typically what you would see is a break higher from this cup and handle and head off to the upper right. Even here in this consolidation, this thing was starting to consolidate into a triangle, and we were waiting for it either to break higher or break lower as it consolidated and became tighter and tighter, this wedge. Typically, these patterns will resolve themselves in the direction of the previous move, which was this move that was higher. You go through the consolidation, buyers and sellers are competing with each other, and it, gets into a tighter and tighter wedge, and then either breaks down or breaks up. I would like to see, we've had so many false starts with gold, but sentiment is so low that I'm feeling, like we may have made the right call here. And we were a little bit premature, I think, in some other calls we made like a year ago. We should have, we thought maybe this was going to be a resolution here, but this is really classic, what you'd want to see. So with sentiment being so low, with this wedge pattern that appears to have resolved or broken through to the upside, what we want to see is a continued move and put some more distance between to the upside here before we see a pullback on profit taking. What we don't want to see, we just want to make sure this isn't a false breakout. We want some confirmation, and that's going to take some time. So over the next several weeks or months, couple months, we'll see if this resolves higher. And this kind of fits into the thesis. You could make the case that, is this just because of the Russia-Ukraine situation that, a little bit of fear has generated in the world, so this is a safe haven run? You could make that argument. That may be the case. And then as things kind of die down, which they appear to be beginning to do, that the gold price would succumb to that and move lower. But I think that that may not be the case here. I think what we may be seeing is the fact that, this resolution of this consolidation pattern, and the fact that people are starting to realize that how high is the Federal Reserve going to raise rates? They're constrained a little bit here too, right? $30 trillion deficit that the United States has. So you're going to raise rates, and then, you can start doing the math on that. If you want to get to 1, 2, 3, 4, 5%, what that would mean in interest payments. And then we're still adding a trillion to $1.5 trillion a year to that debt. And then, you got to remember, the Federal Reserve and the federal government put a tremendous amount of heavy lifting into rate cuts, quantitative easing, fiscal spending to get us through the demand gap that was created by the pandemic. And so do they want to raise rates really quickly and basically waste all that energy and have like a 50% decrease in stock prices? We have an congressional election this year. Does the Federal Reserve want to be trying to raise rates in the precarious economic situation and be on the hook for being blamed for causing a recession in an election year. We do have, I think the Fed still believes that, and this is where a lot of this is speculation, guys. I'm not an economist. I'm not, but we have to work from some framework. And so I just don't think, I think that the market's expectations for rate increases is a lot higher than what reality ends up being. And it may be the case that gold is going to sniff this out. And certainly if we start getting into the Fed would like to have some room to cut rates if there's a potential for a recession. And if you're already sitting on zero, I mean, what are you going to do? So they would like to raise rates, but they don't, and they want to deal with this inflation, which I think they still think is transitory in their minds, or hoping at least that even the year over year comparisons at least come back off these 7%, 7.5%, and drop to 3 or 4%. They just do not, they're kind of they've kind of painted themselves into a corner. So I think maybe gold is sniffing this out. Maybe this is just a manifestation of a safe haven chicken run, because, when things get scary, people go to gold. It's difficult to say. We'll have to see over the next, like I said, several weeks, months to see what happens. But this is definitely positive. I mean, this wedge was getting tighter and tighter, and we were waiting for it to resolve either to the upside or downside. I put no credence into the Russia-Ukraine situation. I was expecting a resolution. That's what I wrote in the February newsletter, that I thought this would resolve either up or down. And based on my at least amateurish understanding of technical analysis, that typically these type of things resolve to the direction that they the trend that was in place before the wedge was created. And then I said, again, this multi-year cup and handle that's developed could be a tremendous long-term, when I say long-term, the duration of this decade, bullish to the upside formation. So again, we don't want to read chicken entrails, just point these things out. And, it's very interesting. If this thing continues to move higher, and we get above, 1950, and then we conceivably, we're not very far away from breaking the all-time highs. If we're able to do that, then it's a whole new ball game. Something to keep an eye on, because I believe there's a lot of room for gold to run on the upside. Gold stocks, wanted to see how they would act. They've made this is the GDX, which is the gold miners ETF, mostly larger gold companies. You can see barely broke out to a new high. This is very volatile. This is all over the place, but this is positive. We want to see this continue to move higher. If gold is to break its price all-time high, we'd like to see this make a new 52-week high, if you will. But we're not out of the woods yet. I'm not saying we're in a full-blown gold bull market, but it's something to keep an eye on, because really no one's watching gold at all. And this is just a perfect setup from a sentiment point of view. So back to oil, which is still seems to be in the news. We had pulled back quite a bit this week. I think a couple things. Oil's run quite a bit. Obviously, we needed to pull back. Things are, like I said before, don't just go straight to the moon. The Russia-Ukraine thing may be cooling down. You can sit here and try to find reasons why. The bottom line is the thing has run quite a bit, $20 or so since the beginning of the year. It needs to cool off and consolidate, but all the fundamentals that we were looking at are bullish still. And, we're in backwardation. Inventories are continuing to go down. Demand continues to go up. We're making another all-time high for this time of year for U.S. demand. So these are all positive things. So we continue to watch it. We continue to expect oil to move higher throughout this year. And, I thought that oil would hit $100 a barrel sometime this year. We may have to change that forecast. We had to change it last year. I thought 80 would be the high. We moved through some of these numbers fairly quickly. So we do need a pause to refresh. But like I said, the oil stocks are still not trading to where the oil price is. So that's either an indication that people don't believe in this move, or they're just lagging because the general investor just hasn't caught on to what's going on. And like I said before, we don't need oil to go to $150 a barrel. Oil at $70 to $80 a barrel, and the cash flows are tremendous. At these levels, the cash flows are extraordinary for a lot of the companies that we follow. And so we just want to give some of the news as what's going on in the oil market, because it continues just to be one of the most fundamentally bullish markets out there. So I will put links to the articles that I reference, as I usually try to do, just so you can go check it for yourself and think for yourself and do your own research. It's not me putting a bias or spin on these things. Everybody's biased, but go look at these articles yourself in these weekly market updates and do your own research. Pioneer, which is one of the big Permian Basin producers, pledges to hold U.S. shale output near flat in 2022. This earnings reports are coming out, conference calls, and people are starting to report on what these companies are saying. Permian Basin producers' capital budget in line with estimate. Devon, Continental also are holding back on production growth. Marathon Oil, which is another big Permian player, which also vowed to keep production largely in check. Investors have been concerned that oil prices approaching $100 a barrel would entice management teams to ramp up drilling and face the threat of a renewed supply gut and retaliatory market moves by OPEC and its allies. So we continue to monitor the conference calls, monitor what these guys have been saying, and make sure what they're saying matches what they're doing. And that's it. They're not going crazy, drilling a bunch of wells, living above their means. The rah-rah drill baby drill days are over. We've talked about this before. We just want to continue to follow up and listen to the conference calls and see what these guys are doing. And they're not going crazy. They're returning cash to shareholders. They're raising dividends. They're paying down debt, and they're buying back stock. That continues. And that is not bullish, or that's not indicative of a, big increase in supply in the Permian. Now, there are independent operators out there. There are private companies. They are drilling. If a guy out there in West Texas is an independent oil man that's been doing this for 30 or 40 years, and he's got some acreage, and he can drill a well that he can get a tremendous internal rate of return on, 100% or more, 50%, something like that, whatever he's calculating, those guys are going to drill, and that's what you're seeing. But is that volume of drilling going to be sufficient to deliver the oil that we need? I kind of look at this oil market on the supply side as three-legged stool, right? You have U.S. shale as one stool, and I think we've knocked that leg out. The large international integrated oil companies, they're not spending any more money. As a matter of fact, they have tremendous pressure on them, especially the European companies like Total, BP, Royal Dutch Shell, whatever, to divest themselves of oil, to commit to spending less on hydrocarbon development and spend more on renewables. So that's the second leg of the supply stool gone. And now the call on OPEC. OPEC has to do all the heavy lifting, and as we've demonstrated week after week, month after month, OPEC is pledged to return, or at least announced to the market that it's going to return 400 barrels per day of supply for the last several months, and they still haven't been able to do it. And they're not doing it because they don't want money. They're not capable of doing it. And so when Ferg and I were talking about this on the interview this week, I kept asking him, or making the comment, because I'm trying to figure this out. Where is the oil going to come from? It's not going to come from U.S. shale. It's not going to come from the integrated international oil companies. And it looks like the call on OPEC Plus is not being answered. So where is the oil going to come from that we need? Iran? Iran does export oil, guys. It's not just sitting there doing nothing. It illegally exports. The Russian mafia is involved. Stuff goes through Syria, illegal tankers. Now, it's not what they could potentially do, but what is that? Another 1 million barrels a day? 1.5 million? We don't know. That would get absorbed fairly quickly in this type of hot market. Remember, I just said that U.S. demand for this time of year has hit an all-time high. You're seeing pre-pandemic levels of oil consumption being exceeded at country after country. And I'm not talking about Denmark, I'm talking about India and China. Okay, so the demand is going to increase. Think about as we come out of the winter, we should be building stocks right now. What do I mean by that? We should be building crude oil stocks and product stocks, and we're not doing that. This market is hot. Like I said, the oil market's in tremendous backwardation, and that is indicating to the market, the prices, that give me more oil. There's, I don't want to use the word shortage, but there's a demand for oil that's not being met in the near term, and the market, that's why the market's in backwardation. The price is saying, and the curve is saying, we need more oil, produce more oil. And we're not seeing where that oil is coming from. Again, if you know where all this oil is going to come from, tell me in the comments, because I can't figure it out. So this is Open Square Capital. Somebody else, if I were you, I'd follow on Twitter. But here is Devon, Marathon, Pioneer, and Continental, I believe, in kind of their CapEx budgets and their 2021 production and their 2022 forecast. Their forecasted CapEx budget growth here, but you're not seeing a lot of increase in projected increases in oil production or oil equivalent production, but yet the budgets are going up across the board, but they're not increasing oil production. So it says here, stunned. Could that be E&P discipline holding, production staying low? We're getting off the treadmill like a herd of turtles, probably tortoises. So, we're just not seeing, they're doing what they said they were going to do. This is just another way of showing it. So again, U.S. oil inventories plummet on bullish demand. Product storage enters draw season at multi-year lows. U.S. implied oil demand on a 4-week average hit an all-time high above 22 million barrels a day. Wow. We're now at least 2 million barrels a day above demand on OECD. That's the basically developed world Organization of Economic Cooperation and Development. That's your Europe, US, Australia, New Zealand, Canada, Japan, that kind of stuff. So we're 2 million barrels a day above demand than any analyst demand estimate. So the analysts have got it wrong. They are behind the curve. So we are looking at demand being 2 million barrels a day higher than all the analysts have forecasted. And as for product storage, we're going into the draw season at one of the lowest coverage ratios ever, as at below 28 days of coverage. So this is bullish. That's why the oil price is in backwardation. It's saying, give me more oil, producers. So obviously, like I said, nothing goes straight up in a line. Oil kind of finished a little bit weak this week, or weaker by the end of the week, but I'm not worried about it. Right now, this is tremendous what we're seeing. And, until we see something change, we have to remain bullish on this market. And obviously, we've made a tremendous amount of money to this point. I think some of the stocks in the AIA portfolio have played out very well. They still have a while to go, but, people are recent subscribers and they're like, well, no, I can't say that you're going to be 10 bagging from here. The time to get the 10 baggers was back when oil was, in the middle of the pandemic, when everybody thought the world was going to end. That's when you have to buy. Yes, some of the stocks we own could double from here, but the, multi-bagger situation is probably in the rearview mirror, at least with a lot of the E&P plays. I'm going to show you, tell you why I think, again, why oil services still can be multi-baggers. And I have, people got a little bit riled up, I think, when I said I took down my Athabasca oil stock and sold it. Well, I rolled it into services. I don't think, I had like a 10 bagger, depending on what stock, what I had, anywhere from 9 to 13 bagger on ATH. Do I think it's going to 10 bag from here? No, I don't. But I think there's some service companies that could 5 bag or 10 bag from here. And that's why, you know, I'm rolling the money. That's what you have to do. Now, I haven't sold all my E&P and just went, you know, full ham into services, but I'm starting to, you know, look at the services a lot heavier. And these type of markets, just to think about this, guys, you know, these things don't resolve themselves. Eventually, the price will go high enough where demand will get choked off and a supply response will happen that will be sufficient to bring the oil price back down. This is a cyclical market that will remain, that will not change. Understanding that cyclicality, understanding how to play it, understand how long it takes to quench that oil thirst or get to a price level that will choke demand, that is what you have to kind of understand. And so we're not in the first inning of this move in oil. We're probably in this 6th or 7th inning. So it doesn't mean there's not gains to be had. It doesn't mean services look really good. They really haven't moved at all yet. And I believe in order to get the supply up, you're going to have to see increased spending, and it will come. I mean, the oil price will get to a sufficient level where even all these shale producers are going to they're not going to be able to hold it back. They're going to have to start investing, and they're not going to leave wells out there that are going to have, you know, 150, 200% internal rates of return and not get drilled. That they will get drilled. And, you know, right now we're in maintenance, you know, they're spending maintenance capital on maintaining production and talking a good game, which is good. But at some point, I think it's going to break through. And one of them goes, it's going to be like a herd. So this thing will fix itself. I don't know at what level. Either demand will get choked off, you'll have a recession, or it'll be a combination of both, more than likely. So there is opportunity there, but you're not going to get 10 baggers now in E&P stocks for the most part from these levels, in my view. So here's Eric Nuttall. We're talking about this, you know, this is where I made the comment about the 3 legs of the stool. Here's one. He says, the era of U.S. shale hypergrowth is over. Growth, yes, but not like in years past when it exceeded growth in global demand. Now there is a call on OPEC and the super majors, one which soon they will no longer be able to answer. And it goes on, talks about Devon, which we talked about earlier, amongst the other basket of companies that, you know, they're going to restrain their growth capex. And so we already talked about the global super majors. The call to them is not going to get answered because we already know that they are paring back their spend because they're getting pressure from ESG and from governments and from society at large. And then OPEC Plus, we know, has been pledging 400 barrels per day of new supply for the last several months and has not been able to meet that goal. And so again, where does the oil come from? We're not sure where all this oil is going to come from to quench the demand. You know, we're getting ready to come out of this winter season. There'll be a shoulder season in the early spring, and then, you know, there's going to be a summer driving season. There's going to be a lot of vacations. If, you know, people have told me, well, you know, a lot of people spent their stimulus checks. Look, if people have credit cards, if they have access to money and credit, they are going to go on vacations. I think somebody showed it on Twitter the other day. You can't get a room at Disney World right now. It's already booked. A lot of things are booking out. People are going to splurge. They're going to travel. They're going to, you know, they've been locked up for 2 years. That's pandemic restrictions are receding everywhere. And I think we're going to have a tremendous summer this year, driving season, and with tremendous demand for oil. And again, as aviation demand returns and jet fuel demand, that's not even being factored in. Those restrictions are going to start getting pared back more and more also. So it's very bullish. You know, I look for what could short circuit this, right? And I think a real spike in oil prices could crimp demand. I'm not really so much worried this year about the Fed. I don't think they're going to go super crazy with rate increases. As a matter of fact, I think they're going to under deliver what the market thinks. And I think that's another reason why gold and commodities will probably move higher throughout the rest of this year, but we'll see. but I just don't see the big supply response. So the only thing that you can see that's going to fix this market is a rise in prices sufficient to choke off demand. And that's substantially higher than where we're at right now. So I was talking to my wife. She's she's been in Ukraine for the last 9 months. And so I talked to her. I've been joking with her. I said, there's a big frenzy here in the news here in the US, and there's going to be an invasion, and the Russians are coming. What are you seeing? Are you worried? She said, no. What are you talking about? There's not going to be, there's nobody here is talking about it. Nobody's worried about it. This is nuts. And she's not in Western Ukraine. She's in Eastern Ukraine. So she is ethnic Russian. So has a little bit of sympathy towards Russia, even though she's a Ukrainian citizen. It's a complicated thing, but this is the kind of thing I like to see as a contrary indicator, right? Here's a message from Interactive Brokers, Russia-Ukraine conflict. Dear IB client, as you are likely aware, the elevated tension between Russia and Ukraine has led to increases in regional and global risks. The situation is fluid and no official sanctions have been announced. We remind clients that holding Russian securities traded on the Russian exchanges, that these assets are particularly exposed to economic and political events, yada, yada, yada. IB cannot guarantee the accessibility to our liquidity in these assets, and clients concerned with such impact should consider appropriate steps to mitigate these risks. Cannot guarantee the following might be affected: assets denominated primary or secondary in rubles, energy sensitive assets, impact on European and global markets deriving from interruptions in commodity and energy supplies, general market risks. So long story short, I look at a chart of RSX that already bottomed like last week or the week before. I kind of publicly announced that I was speculating and moving in. These stocks are tremendously cheap. So if you don't think that the Russians are actually going to invade, which I don't think, and maybe they have, and I haven't just kept up with the news, I'm maybe a day behind, I don't know. But from the reports I'm getting from my people in Ukraine, that they're not too worried about it. So this was all, I thought they were going to invade this week. It was funny. The spokesperson for the Russian Ministry of Foreign Affairs was given a press conference, and she kind of was asking the reporters, could you tell me when the invasion is going to be? Because I would like to schedule my vacation, and I'm not clear on when this invasion is that we're supposed to do. But if you guys in the press can tell me, in the Western press can tell me when the invasion is, then I can schedule my vacation around. So there's some sarcasm there. Lavrov, the foreign minister, likes to poke people. Look, the Russians play chess. They have the leverage. NATO, is not, the other members of NATO, Germany, France, they're not interested in a war in Eastern Ukraine. I don't know what these people in the United States are up to. Long story short, I've been bullish on Russian stocks for a couple of years. I continue to remain bullish. This is a tremendous buying opportunity, speculative buying opportunity, in my opinion. Some of these companies are very, very cheap. The dividend yields are very high. And, people have written me and said, when I've mentioned this before, well, what about asset seizures? What about all this? What about asset seizures? You could be in Canada right now, and because you support free speech, you can have your bank account seized and shut down. So you tell me who the tyrants are. You tell me who the bad guys are. Okay. You tell me who steals stuff. I've been getting my dividends from Gazprom for years, uninterrupted. Not a problem. No one's stolen from me in Russia. So if you're a Trump supporter, though, and you're sending Bitcoin to the truckers in Canada, then you're an international terrorist, and your assets will be seized. That's not the Russians doing that. So here's from Offshore Magazine. Demand for floating rigs soars in February. Vessels with MPD systems increasingly sought. So I'll put a link to this article. I titled this slide, "You got to buy before it becomes obvious." You got to buy before it becomes obvious. I've been having it in the newsletter for probably a little bit over a year. I've got 3 or 4 offshore stocks. They really haven't moved yet. They've come off their bottoms, but they haven't moved yet. But we're seeing more and more indication that the offshore drilling market is healing, and the ancillary services and support services that are there are healing. Now, that doesn't mean we're going to have this tremendous bull market. You look at the OIH, the Oil Field Services ETF, and the constituents of that ETF, And, you have a lot of the big names in there, right? Schlumberger, Halliburton, Baker Hughes, some of the offshore drillers, some of the onshore drillers, other companies, Helix, specialty. I mean, there's all kinds of companies in there. And if you go listen to some of the conference calls for the majority of them, they are all saying that their businesses are getting better. Now, I'm not expecting a boom time in the oil field services. Again, we don't need a boom because the industry has atrophied and shrunk so much that it's a smaller industry, so that when the capital does come back, it's being showered on less companies that are smaller. And so the resultant effect year over year and sales, and this is why I'm looking at a lot of smaller onshore service companies, not necessarily drillers, but other companies that support other activities. And I was looking at the Q3 earnings. A lot of the Q4 hasn't come out. The Q3 earnings year over year were massively bullish, and the forecasts were massively bullish. So, and still a lot of the stock prices really haven't moved tremendously. And so, again, I think it's an opportunity. If you wait till, I'll give you an example, like Transocean sells for like $3.50 a share. So if you wait till it's $10 before you buy it, I mean, you give up all those gains right off the bottom. This is part of the speculating and investing in the kind of things that we do. A lot of times you're going to be early and you're going to have to wait. And that is so hard to do. Like we did in uranium. I mean, we're getting paid. I mean, if you look at my uranium picks in my newsletter, all of them are up hundreds and hundreds of %. Now, can they continue higher? Yes, they probably will go higher, but a lot of the big gains have already been made. The easy gains were made already. So we have to sit through 2 years since I started this newsletter when nothing happened. Week after week, month after month, no news, no positive news, no news out of the companies. They just drift in a range, boring, and see, but that's how you make the money. That's when you're accumulating Paladin at 10 and 12 and 15 cents. And it's now, at its highs, 52-week highs was almost $1. So that's how the gains are made. If you wait till it's on the front page of, the Wall Street Journal or whatever, Forbes magazine, it's too late. If it's in Barron's on the front page, you've missed a large part of the move. So you have to get into these things when everybody hates them. Nobody wants them. Sentiment's terrible. And you have to be able then to sit there and just refrain from activity. And that is what's difficult for people to do. A lot of people, I mean, and they've done it, right? They've turned the markets into a casino, a circus, Robinhood. I mean, I don't have a Robinhood account. I've just heard how it works. Even you set the account up, balloons and fireworks go off, and they turn it into like one of these slot machines at the casino with all the visual and sound effects that are there to stimulate your, pleasure centers in your brain so that you will, spend more money or trade more. And this just isn't how money's made. Identifying blown out, cheap things that have a catalyst for change and then sitting there, you're going to be early on these things. I'm trying to, introduce some more, wait for at least a uptrend to develop or something like that. That's what Paul Tudor Jones talks about. But even that's hard for me to do. I just want to, if I have a conviction towards an industry, towards a turnaround in a country, or what have you, on an asset class or asset, then I want to accumulate as much of that asset as I can cheaply, and then wait for the turn. That's how the life-changing wealth. One of the things I have to say is there's been probably a half dozen people that have been subscribers to my newsletter. I don't say this to brag. This is why I take this seriously. I have a tremendous responsibility, but I've had probably a half dozen people write me and thank me for kind of helping them, hand-holding them and teaching them, and maybe even supplying some, ticker symbols in the newsletter, that some of these people have completely changed their life. They've created wealth that has changed their life. Some people were able to get through the COVID things with job issues and stuff because they had wealth they had resources that they had invested or from their investing and speculating after having subscribed to my newsletter and having, and I take that seriously. That is, I do this to make money, obviously. I believe that anything that's being done should be done at a profit, but this is tremendous responsibility. That's why I don't like to be a hack. People say, man, you should have 100 times the YouTube subscribers. I'm not going to go out there and just be a hack and promote. Yeah, buy this, gold's going to the moon. Yeah, find out what's hot, has the hottest RSI, go on the new highs list and just pump. I don't do that. I try to be level-headed. I try to check my biases. I try not to be a FOMO guy. And I try to, bring the lessons learned from, close to 40 years of investing in the markets, the majority of which I wasn't successful because I didn't know what the heck I was doing. So I kind of deviated, for a little bit here, but I got to get this out here because there's a lot of opportunity in the market. Okay. But you have to do it correctly. And most people just don't do it. They become disillusioned. The stock market sucks. Don't invest in the stock. That's the wrong attitude. You have to stick to some core concepts. You have to sell overvaluation and buy undervaluation. You have to understand how to determine overvaluation and undervaluation. You have to have a basic understanding of how to, especially in the markets we deal with, of cyclicality and understanding what that means and not be a linear thinker. Understand that these are cyclical type situations. Everything's pretty much cyclical. And understanding that and using that to your advantage gives you an advantage. Sticking with things that, we have no advantage, like I said before, investing in Costco or Facebook. There's so many analysts. I don't know what's going on. I mean, people fly drones over Costco parking lots to figure out, what the sales might be inside the store. I mean, we can't compete with this, but what we can do is we can operate in niche areas of the market where we can have above average intelligence, above average advantage. And the fact that the large money managers can't, because of the size of the market caps, can't really invest where we do because it's too small for them. So that is our advantage. And then being early and not having to report to an investment committee and being able to sit for 2 years with our conviction. If I would have been a money manager and bought all his uranium stocks and nothing happened for 2 years, I'd have been fired. They would have brought a new manager in. He would have sold everything and did what he wanted to do. And we don't have to do that as private investors. We have the luxury of time and patience as being one of our key advantages. So like I said, we got a little bit off track there, but I feel it's important to talk about these things and remind people about how to have success in these markets. So Doomberg, please subscribe to these people. They're really good. They have a Substack. It's free. I suspect it'll eventually not be free, but they are growing really a lot of great articles. But snag this off their Twitter feed. This is what they wrote on their Twitter feed. This is drilling in uncompleted wells. New duck report saying Quack. Look, I mean, that's what has kind of held up U.S. shale production. We've been completing these previously drilled wells where we're getting down to levels that are, I don't know, lower than 2014 now. We don't see anything turning around. This is certainly not bullish for supply. As these become brought online, they deplete quickly, as you well know. And who's drilling the new wells to overcome these drilled but uncompleted wells that inventory is drying up? Another bullish indicator in my view. And so I wanted to talk about this. I'll put a link to this in the show notes. This is an inflation calculator. I'm not knowing how precise this is, but I want to give you an idea. Why? Because people say, well, $150 a barrel oil, if we hit that, then that's probably going to be it, right? Because that was the previous high back in 2008, whatever it was. I looked it up on one of the charts. It was like 148 or 158. I can't remember. So basically, I put in here, if in 2008, I purchased an item, which would be a barrel of oil, for $158 a barrel, then in 2022, the same item would cost. So in order to inflation adjust for the all-time high in 2008 of oil, it would have to be $206 a barrel. And so if somebody says, well, oil at 130 or 150 is going to kill the economy, that's not a new high. You have to adjust for inflation. The inflation adjusted high would be 206. And typically what happens in these markets is that they usually blast past the previous high. So when you hear people say we could see a spike to 250 or $300 a barrel, that is not unrealistic. That's not probable, I admit, but the chance is a lot higher than zero. Let me tell you that. It's not as low as people think. These markets have a tendency to explode to the upside. You saw what happened in gas in Europe this winter. You were trading natural gas prices at oil equivalents of above $300 a barrel. So it is possible. I don't know how likely it is. Again, I'm not a fortune teller, but you have to consider the inflation adjusted price in the context of determining what the real all-time high would be. So to get, we'd have to see $206 a barrel or roughly. I'm not saying this is dead nuts on, but it's close enough for what we're trying to illustrate here. So you could make the case for easily for $200 to $300 a barrel oil. I don't think it would stay there for very long, but you could have, a blow off top in our stocks, and would definitely, like I said, would definitely positively impact your brokerage statement. So I'll put a link to this. You can play around with it at your convenience. All right, guys, that's it for this week. Again, appreciate I get a lot of good feedback, very rarely any negative feedback anymore. The ankle biters seem to have moved on to greener pastures. Got a lot of serious switched on people. I get a lot of comments and emails from people in the industries that we talk about. I find that information invaluable. You guys are out there, you're seeing things that I don't see, and I appreciate the emails. I read every email. I try to respond to all of them. If you reach out to me on Twitter, I normally respond to people. If I don't respond to you, please don't feel slighted. I'm a one-man band. I am working a real job. Like I say, I'm recording this on Friday night for Saturday consumption because I actually have to go and work on this industrial site that I'm building on Saturday. I work 6 days a week in a real job. So I'm not asking for any sympathy. I'm just giving you the explanation why sometimes the videos are late or necessarily I don't respond to you. Same thing with people that are subscribing. That's why I put in the subscription notes. Give me 24 hours to get your subscription out to you, just because, like I said, I got a lot of stuff going on and I'm trying to keep up with this. So it's going to come to a decision point here, I think, in the next year that I'm either going to have to, I'm going to have to take this full time if I'm going to do it seriously. It's getting to the point where I can't just do it part time anymore. So, and it has been very lucrative, and I do thank you all. You guys have brought me to where I'm at. And I never thought in a million years that people would actually want to listen to what I have to say about things. And like I said, we get a lot of positive comments, and I get a lot of satisfaction for helping people. I do take this seriously. People have entrusted me with a lot, and I don't take that lightly. And it does mean something to me. So anyways, I don't want to get all sentimental here, but appreciate you guys. And just wanted to say thank you. All right, guys, we'll talk to you next week. Take her easy.